understand that, Mr. Secretary. I would imagine for the purposes of numbers, though, that come out of a group like BLS, what the American public, what the world public, the CEOs in America, the Fed, anybody who's making decisions on these numbers, actually, they don't want someone who's there to win. They just want somebody who's there going to give them the most accurate, timely numbers that possibly exist. Just accuracy is probably the only thing that they want. So what I'm asking is today, when we see those numbers, whether we should believe they're accurate.
I think they'll get better because he'll take out the people who are just trying to create noise against the president. Take out the people trying to create noise. Let's get the accurate numbers because this is going to be the greatest growth economy, right? 6 months from now, a year from today, as these trillions of dollars of plants and factories. You've seen all these pictures. They are just so many factories going in. The employment situation in America is going to be so impressive. Look, we've got 3% GDP growth. Nothing wrong with the growth we're going to have the rest of this year. But the Donald Trump economy, the explosive power of his tariff policy, his plants being built in America, to come home and build advanced manufacturing in America, when that comes starting 6 months from today to a year from today, you're just going to be impressed. I'm going to come on your show, and I'm going to make you say, Donald Trump was right, and we are all impressed.
Right.
There we go. Welcome back, chaps. It's another weekly market recap. It's the weekend, so happy weekend to you all. A very eventful week, I would say, both from the economic calendar standpoint, and even if you kind of like me, you do follow and you do like these, these narratives, these side line themes, right? Like we've got Lisa Cook against the administration, and then we got, the possibility of Trump's tariffs being unconstitutional. And this week we got Lutnick going after, the different entities in the US collecting and elaborating and processing the data in the US. So, if you like those themes, it's just sometimes I wonder why I'm paying a Netflix subscription when you got weeks like these where it's so fucking entertaining, right? And again, I tend to not be political because I guess it's useless. But in the past, I've been mocking on Biden, on Kamala Harris, and I guess this time around I wanted to mock a little bit on the MAGA movement and all the rest. I don't necessarily think that everything Lutnick said was completely incorrect. As he said, it might take 6 months, 1 year, or whatever. We'll see about that. It's just that the character, it makes me laugh so much. It looks like he came out of a cartoon, for fuck's sake. So, I guess I had to do that. Now, before this whole thing will get out of hand, let's have a look at the economic calendar and what was the week that just ended. So we got ISM manufacturing PMI, which increased, right? They came in at 48.7. But still, in a contraction territory, right? This is a diffusion index, so whatever is below the 50, it's still considered a contraction. And, you can just read the recap for the data, and it's not particularly enticing, although, at the very least, it bounced a little bit, right? Now, going on, what we got, it's another dire situation, maybe. ISM manufacturing employment. So yeah, again, getting back to the beginning of the video, Lutnick might have a point in the next 6 months, 1 year, or whatever. But for now, if you think that Trump took office in January and these data was at 50.3 and now it's at 43.8, so yeah, I guess good job, mega policies, right? Okay, right. I'm gonna cut it, right? I'm gonna stop it, right? Okay, let's just say actually this is true. You don't know how long it's going to take for one policy or the other to actually manifest its own effects, right? So what's important to understand, it's the goals, right? Now we can talk about the all or whatever unintended consequences these policies may cause, but just sometimes you can just look at what the aim is, what the results so far have been, and define your own conclusions. For me personally, I just think that it doesn't really matter what they do in the very short term, right? There are many other different factors which are actually impacting this data point right here, as for many others, but this one in particular, I guess. So it's not cool, and I don't think it's going to improve real soon. So for now, I still think when you look at the employment in general, we are looking at a situation which is, I don't want to say horrible or ugly, but deteriorating at the very least. And we're going to get a bit more into it later on, right? So moving on, we got jobs openings down, and we missed expectations, I guess. And even the trend, as you can see, it's, I mean, it's bad. There is no other way around it, right? The situation, it's not improving even in this data set. Now, going ahead, ADP employment change down again. So it's hard to be particularly bullish on the labor market in the US for me right now. Um, I'm still thinking like maybe we are not really at that point where you can start to panic for real, but I guess we are really at that tipping point, that moment of truth where either you kind of rebound a bit and try to make something or to come up with something to improve the situation, or that's a very slippery slope in my view. So even this one, not cool, and I don't think it's going to improve particularly quickly. So the jobless claims, of course, doesn't really matter where they came in. What matters again is the trend, and to me, it's still it's stalling a bit, but surely it's not improving compared to, I don't know, let's say maybe 5 years ago. Although the 5-year chart, yeah, it's too big of a chart, and you still have the distortion, which were caused by the Inflation Reduction Act and all the rest. So I mean, you look at it in the very short term, 3 years, not cool, but at least this one, it doesn't look terrible, as we have discussed in the past. Although the continuing jobless claims are still particularly elevated. So then again, not particularly cool. Moving along, we got the ISM Services PMI. Now, this one rebounded a little bit, although it looks like it was a positive data, maybe the only one positive this week. Although if you dig a little bit more into it, there was something offsetting these positive indicators, like continued contraction in employment, no shit, 60-year low for backlog of orders, not cool, and elevated prices. So you know maybe this increase, it's just in nominal terms, but it could also be tied to what we've seen in other sectors and parts of the economy as for the front run of tariffs, and therefore economic activity or future demand which is pulled into the present from the future. So again, at a point there should be a give back period, or something, right? So positive note, but all in all, still far from being super hugely positive or optimistic, let's say. Now, here, the kind of the elephant in the room, not only for the week, but if you remember, even in the past last month, we got NFP missing expectations again, being particularly bad as the headline. And the revisions, oh boy, the revisions were even worse than that. Now, of course, I guess May was maybe revised higher, but June, well, June was terrible. Now, let's have a look at one thing for a minute. Like, think about it this way, right? This is what we got. So again, June was revised lower, and it turns out after the revisions, it's the first negative print that we got since the pandemic. So not cool, right? Now a much clearer depiction of this headline coming out and then the revisions, right? Here's what we are looking at. So many different you know data points have been just revised lower after a while. So look at just look at the last what 4 or 5 months in here. I mean, that's not cool, right? And even if you check the household survey, I mean, it's a bit noisy, right? I guess sometimes maybe the good thing to do would be look at the moving average for this one. But again, if you look at the last 4 months, for instance, what you see is that, yeah, we had a rebound this month, at least in August, right? But the majority of it, if not all, it was just poor time jobs. So not cool. And all in all, if you just take the aggregate for the last 4 months, looks like we just shaved off 500,000 jobs. So you know, both the establishment and the household survey are now in line, kind of describing a very dire situation, or at least a very precarious situation, so to speak. Not cool at all. But this is what really it's really striking to me. This is basically the report. As you can see, the initial reading, the first revision, and the second revision. And like, look, if you start out for 2025 alone, right? You see that every time January, February, pretty much all the months, the initial reading, so the headline which came out was cool, right? I mean, what I guess whatever is above 150K should be good for the US. Many says that you would need 200K each month in order to sustain uh, the economy and the job market when you adjust for the population growth. I don't know if that's a solid estimate, but let's just take something like 150, just to throw something out there and to say, well, that should be definitely positive, right? So look at how many data points actually came in at and around that level and was, at the end of the day revised. And when you account for all the revisions and you kind of make a sum of all these ones, I mean, it's bad. I mean, did we really created jobs in the US year to date? I don't know, right? So, I mean, looks like we actually lost jobs at the end of the day. Uh, so again, the thing for me, I told you in the beginning, the fact that I'm so, on one side, I'm pleased because I do like these themes. I do like these narratives. Sometimes it looks like a sitcom, right? Although when you think about that, it's very sad for the average Joes and Janes out there. But I guess that's the problem we are facing now. Okay, so it's hard. And do you remember when I said I feel a little bit of sympathy for Jay Powell? Imagine having to set monetary policy based on data which are revised to this magnitude after 3 or 6 months. And then you may moan about the Fed always being late and all the rest, but yeah, can, how can I be early if I'm working and basing decisions on a data set which is lagging or which is not correct when I see it, and I have to take decisions based upon it in real time? So again, it's not just about the Fed. It's the entire system, or it's not just one organ which is deteriorating or malfunctioning. It's the entire organism. It's the entire individual right here, right? So it's a patient which is particularly hard to cure if you got flaws or issues all the way across the board, right? So again, I think when I guess they're gonna have I just forgot the acronym, the Q, the QC, uh, the QCW, something like it, which should be the quarterly census of employment and wages. Yeah, so that was it. So if you think these numbers are bad after the revisions, just bear in mind the QCW, it's going to revise again these numbers. So we don't know if that's the worst we are going to see, or if it's going to get even worse than that, right? So we'll see about that. I guess it should be in the month of September. I don't know if it's next week or maybe the week after that. I don't really remember for now, but just bear in mind it's going to come, right? Oh, well, like 4 days. Considering these data was published, I guess Friday, so it's going to be next week. Oh, all right. Okay, we'll have a look at that when it comes out. So and now it looks like, do you remember the job openings collapsing? So it looks like now uh, there are less jobs created compared to the people which are actually looking for a job. So again, not cool. And it looks like that was in this that was actually in the calendar. But anyway, that's the recap of that. It looks like we are actually starting to see job cuts now, right? So again, the labor market, it's not cool, right? So moving along a bit quicker because we have just spoiled what was to come next. But the unemployment rate ticked up 10 basis points up to 4.3, which again doesn't look like a lot, but the thing for me, it's the trend, right? This is not a trend which is looking like an improvement. If anything, it looks like it's getting worse, right? With numbers going up for the unemployment rate. I guess these change right here, although minor, could also be due to what we have seen in the participation rate, which again ticked up. Now, again, I've said in the past, you should look at unemployment and adjusting it for the participation rate if you want to have a much clearer depiction of what's going on. But from a statistical standpoint, it's kind of natural that unemployment was kind of stable, but if you got the participation rate coming up, that means that all those people being inactive, not actively looking for a job, and therefore not being counted in the unemployment rate, if all of a sudden, you got an increase in this data set, it means that a bit more people are now actively looking for a job, and therefore they get counted in the unemployment rate. So if you got more people which are looking for a job, they don't have it, right? It just means that, you know, the the unemployment rate will go up just because you have a wider base of people now actively seeking a job, right? So this could be a contribution to the tick up in unemployment. But I was still confused, and this is something I didn't bring up earlier. We have been looking at the labor market for what a bit more intensively for maybe 5-6 months now. And every single time we were looking at the unemployment rate and all the rest. But I actually had to ask to Grok because I'm not American, so I don't know all the definitions. So I just tried to kind of educate myself a bit more. So my question was, okay, could you tell me the difference between all these different unemployment data set in the US? Because when you read a report, actually what you see is the U1, the U2, the U3, and all the rest. Now, I'm not going to read all of these. I guess you can just, if you're American, you should already know it. But if you're not, just do what I did. It's a simple search, doesn't cost you anything, right? But I guess the takeaway here is that what we got in the unemployment rate when it's published on the economic calendar is this one, the U3. Now, when I read the definition, to me it was a little bit strange, if not, it wasn't adding up. In all honesty, because uh, we are talking about people who are unemployed, right, and actively looking for work in the past 4 weeks. But wait a minute, what does it mean? So I got fired, and now I'm looking for a job. Week 1, week 2, week 3. Uh, if next month I will stop looking for a job, I'm not being counted in the unemployment part of the population. I've been out of job for 1 month, and I'm not looking for a new job now, so automatically I don't get counted. Why? It looks like isn't it a too restrictive type of a analysis, right? I don't know. It looks to me it's too restrictive because it leaves out all those people which maybe lost their jobs. They tried to find another one. Guess what? They couldn't. So for the time being, they are just on social security or whatever. And what do? We do pretend they don't exist. So they they don't account in the unemployment rate. I mean, it looks strange to me. And bear in mind, this is the official report. This is what you see in here, right? 4.3. I guess, as Grok says, the broad measure is the U6, which includes everyone. So pretty much, as you can see, all the subsequent categories are, the previous one plus something else, the previous one plus something else, especially when you start to get into the U4, U5, and all the rest. But, the U6 should be the kind of the broad measure because it includes all what is included in the categories above, and it adds up the people which are now working a part-time job, not because they want it, but because they were looking for a full-time job but they couldn't find it. So I guess, yeah, maybe probably Grok is right. I would assume he's right. Maybe U6, it's a much better measure, right? It accounts for many different issues that you can pick up in the labor market or in the broad economy in general. And as you can see in the key difference, you can see that the U3 is criticized for understanding labor market's lack by excluding those not actively seeking work or unemployed. Instead, U6 is favored by some economists for capturing a fuller picture. So yeah, I guess that's the main point. And after kind of realizing that, I was like, okay, so let's see what let's see what the situation was as for the Bureau of Labor Statistics. And when you go in here and you look at the different measures, right? U1, U2, U3, U4, and you look at what was the data reported 1 year ago, so August 2024, what was the data in July 2025, and what it's for August 2025. What you see, let's take U3, which is the official, quote unquote, it got from 4.4 in August 2024 to 4.5, not seasonally adjusted. When you apply the seasonality or the seasonal adjustments, so right, it got to 4.3. So it looks like it improved over the last year, right? Or, if you're still comparing seasonal adjusted type of data, it stayed where it was, 4.2, 4.3. All right. But if you're looking at what, for many people, it's the broader measure and the most accurate measure to capture the fuller picture, U6 went from not seasonally adjusted 8% in August 2024 to 8.2 in August 2025. And when you apply the seasonal adjustment, it's sitting at 8.1 in August 2025. So again, I don't know why people were not so worried up until 1 month ago, because it looks to me the situation wasn't particularly good, even in May, in April, to some degree, even last year. So this situation has been brewing underneath the surface for a long time. And, sometimes call it politics. Maybe it was convenient to just, sweep it under the rug and says it wasn't a problem, right? What do you see? Out of sight, out of mind, right? Okay. So trying to finish up, average hourly earnings month over month stayed flat, but over the last 5 years they are still kind of at the median of the last 5 years, let's call it. And average hourly earnings year over year, here you see that they are actually still trending to the downside. They peaked, as we've discussed maybe 3-4 months ago, they peaked in March 2022, and they're still going down, even if you zoom in, right? Let's just have a look at the last year alone. August 2024, August 2025, not a good trend, right? And average weekly hours, so the amount of hours that people are working every single week over the last 5 years, trending down. So again, wherever I look, there is really nothing which is enticing as for the labor market, so that you can understand why there was that major shift at Jackson Hole by Powell from the inflation risk and now the labor market slacks, right? So this is the one which was spoiled in the slides. So it looks like we are actually seeing a tick up in job cuts. And again, if you get back to just a few months ago, at the beginning of the summer, right? You remember a few companies actually started to announce, layoffs. Not to mention, back then we were still looking at the Doge doing his job and cutting a few government employees and all the rest. So it was just a matter of time before you started to see actual layoffs, right? So it looks like this is the time we see them. And so now the interesting thing will be to monitor where this trend is going to go. Will it be just a tiny bounce and then it is faded, so to speak, or will it be a sustained type of a trend to the upside from year on out? So that's the interesting part we're going to have to monitor going ahead in the end of the year. Now, after all of that, what we've seen, let's say in the break evens, of course, is that they kind of came down, of course, because if the labor market, it's now, evidently struggling, if not deteriorating at a faster and faster pace, sure, inflation expectations should be, downgraded for the future, because it's hard to generate inflation if people are not working, therefore not getting a paycheck and not having the ability to spend. And do you remember last week we were looking at these inflation reads, the unofficial, right, the true inflation. Look at PCE. Uh, I mean, since the beginning of September, it just plummeted. Why, you may ask? Again, because I think the market is looking through this labor market situation and saying, well, yeah, I mean, maybe a little bit of a tariffs inflation, a one-off there, but all the rest is pointing in the opposite direction, right? And even when you look at the CPI through inflation index, what you see, well, again, it's now below 2%. Again, it got this spike and then back down. So still, again, in this range. This is not runaway inflation. This is not higher for longer, at least, at the current moment in time. And probably, given all the data we have been looking at, maybe won't, at least in the near future, right? And again, even the future market, as for Fed funds futures, now what you see is that the current range is 4.25, 4.50. So it should sit at and around 4.33 something. Look at the odds for a 25 basis points cut in September, 90%. But, you remember I said I wouldn't say that a 50 basis point cut is off the table. We're gonna need to look at what the next data coming in will be and how bad they could be. And I think that possibility for a 50 basis points is still on the table. Wait until you see the data before making up your mind. And obviously, it's not that we are, at least the market, it's pricing in a huge chance or a lot of odds for a 50 basis points cut, but last week this one wasn't here. It was completely off the table for the market, and now they're pricing in at 11%. So to me, of course, I don't know if you're going to have a 50 basis points cut. I would say, if I was kind of convinced it was still on the table, now I think not only is on the table, but I mean, I told you in the past, it's kind of the same playbook as 2024. You skip the rate cut in July, the situation get worse throughout the summer. You don't get to cut in August, and then in September you have to panic because things deteriorated, and you weren't expecting that to be so bad when you came back from your vacation, and you need to run for the hill and cut 50 basis points. Now again, will they cut 50 basis points? I don't know, but if the table was set for a potential 50 basis points cut, I think the odds now are increased, and the market it's picking that up. So again, it's just, I guess, as usual, it's not a matter of certainties; it's a matter of probabilities. But you see that maybe that case for a higher than expected cut in September, it's getting a little bit of confirmation now, right? So I guess what we're gonna have is there should be a CPI print before the FOMC. I guess unless we have a big surprise to the upside in the CPI, this 50 basis points cut, the odds for that they're going to increase even more in my view personally, if I'm looking at it right now at the current moment in time. Yeah, GDP now it's still pricing in a 3% GDP for I guess for the quarter. Will it be I don't know. Again, I think it's very volatile, and it could be up another 50 basis points or down another 50 basis points, depending what's going to happen in the next 10 days, 20 days. So it's just about expectations, right? So again, I would say probably at the end of the year it's not going to be 3%, maybe 2.5, something like it, but not 3%, right? It's very optimistic in my view, as I said in the past. At least, as for markets, credit spreads are still particularly low, so not a huge alert or warning signal there yet, but we've seen them being particularly down, historic lows. So at a point, there's only one way from here, right? Yeah, they could stay flat for another month, 2 months, 3 months, whatever you. But you check the past, and every time they got to these levels, sooner or later they had a little bit of a spike to the upside. It's just like volatility, right? It contracts, it expands, and all the rest. So that is the situation as for the economic calendar, and and if you uh, call it themes or narratives or mainstream media topics, should you be particularly stuck to them? As for the data, I would say yes. Even though we are seeing they could be laggy, they could be incorrect, and the revisions will kick in massively over time. And remember, the market will only pay attention at the headline. So if you're trading in the short term, all of these, does it really hold any water for your activity? Maybe not, or probably not. But for the long term, yeah, it does. It actually does. So that was it. Now let's diving into some charts, because this section right here, I reckon it was particularly long. But hey, there was a lot to discuss this week. As I said in the beginning, it was quite an eventful week. All right. So let's move on. Okay, as for the charts, what we've seen is, well, as for currencies, it's pretty straightforward. A bunch of nothing. Still, the XY still in this range. It's tricky again because you might say some weeks it was looking like it was rebounding, and the next week it was looking like it was plummeting. And again, at the end of the day, it's not really going anywhere yet, and it's reflected in the other currencies like the euro, the pound, the Japanese yen, the Canadian dollar, right? And even the Swiss franc. He had his major run up in April on the back on the retardation day, but then lately has been particularly flat. So I wouldn't waste a lot of time on currencies. Actually, I remember I was discussing the euro, for instance, because I'm following the euro the most because it's my own currency, right? I guess it was the beginning of August, and I was like, would you imagine staying in this range for like 2 months? We are at the beginning of September, so if it keeps on going up until the end of the month, which is again another 25 days, that will that will confirm itself a very good call in a way, but not really actionable. I'm not actively trading currencies a lot these days for this exact reason, because the majority of the time they just range in a consolidation, or they're not particularly directional unless you have some sort of a huge macroeconomic event, right? Then again, as for the other currencies that we usually look at, nothing really changed again, especially this week. Nothing. It's still the same. So let's move on. Now, this was this was strange. Now, because on one side, we were looking at this area, right, and the market actually keep on testing into it, grinding into it, and we were saying, look, if it keeps on grinding and grinding, at a point, it's gonna push through. I guess this is one of those times where you just have to call it and recognize things as they are, which is sometimes the market will just be a market, and although you might have all your assumptions, probably it won't be perfect, or it won't be as perfect as you expect it to be. Because I was looking at it, and if you remember, I was saying, yeah, if we can manage to break through, we might extend the bounce a bit higher than that, probably 66, 67, and all the rest. Uh, we didn't really get into these prior apex or these inefficient leg, right? If you remember, we didn't get to 67. We just briefly bridged over, and then it was immediately slammed back down. Now, sure, it's oil, so energy, it's the economy. It's logical to think that with the bad data as for the labor market in the US, um, it took a hit, because it's still the same, right? How can you expect higher prices for oil if wherever you look, it looks more and more recessionary by the day? Again, I'm gonna say it again. I'm not saying we are in a recession, or we are going to be in a recession next week or next month. Also, because it's beyond the point, because the NBER is going to tell you we were in a recession probably 8 to 9 months down the road, being optimistic. But I'm just saying, the market it's pricing in expectations, and so I guess the signal that oil it's giving out is that what came out, again, not cool. Um, it is strange, because on one side I kind of feel like you know my expectations were for a bit more of a higher bounce, but at the same time, my mid-term or long-term type of buyers, uh, regardless the short term, it was still particularly bearish. So did I just get what I wanted? I mean, not that I necessarily wanted. It's just, did I just get what I was thinking? It's the major or the predominant theme in oil. But at the same time, in the short term, I just missed the target. So yeah, I guess we are still again hovering around this base, so it's not completely broken yet. What I would say now is, though, this base provided the bounce once, twice, and the secondary bounce was sustained. It was a bit higher, and the pullback into it in the base now was particularly sharp. Could you say another tiny bounce before actually attempting to completely break it and probably seeing oil below 60? It could be, I guess, but of course, after this rejection right here, at this base already being tapped in twice, I'm not particularly optimistic on oil. Again, the mid to long term premise I got, it's still kicking in, and I'm still thinking we're gonna have lower oil prices. Now, the timing of it's a bit difficult, but do you remember that that dynamic for commodities, as for which commodities price tend to gravitate around the cost of production? I was checking a few reports. I'm not an energy market expert, right? And I'm not, religiously following the energy market, but it might very well be it was a minor report or it wasn't particularly accurate. I don't have the tools to determine that. Anyway, let's call it a rumor, right? And it looks like in the US at the current moment in time, the cost of production for oil should be, in a range in between 55 and kind of, $60 per barrel. So again, would it be, unusual to see oil getting back below 50? Sorry, 60, and getting, in the mid 50 or, you know, something like it, basically below these lows, right? I mean, I don't, if you do believe in that dynamic, which I tend to believe it's reality. I've heard of it being brought up even for Bitcoin when they were looking, at the cost of production, the electricity cost to mine one Bitcoin, and therefore price historically and over time should gravitate around that. So I do think it holds water, which is why I keep on thinking that, over time, if the situation in the overall and global economy stays where it is, I still think oil will travel down in the mid 50s, right? We'll see. So again, still kind of bearish on oil for the mid to long term, although maybe a little bit more on mid term. It always depends on what you define as long term, right? Um, Nothing really changed for me on oil overall. Let's have a look at gold instead, which it kept on rallying. So, we broke out of this consolidation, and I guess, after what? It started in, yeah, probably mid-March. It depends if you want to count this segment right here or if you want to count from the top to the first, low, which initiated the consolidation. But even if you want to call it April, right? Still a few months of consolidation. So the move out of it, it should have some legs. So I think we still have some room to go up in this one. But where to? I would look for some sort of a big figure first. So, the round numbers, right? 3,700. Although I don't know. I think we go past that. Probably 3,750 or 3,800. That would be, let's just say, because it's in price discovery now. You don't have a previous structure to kind of take as a reference point. So I would say it could run, I'd say another $100 because before a major pullback or consolidation or what have you. So bottom line is, I'm still thinking this has room to run over the next 2 or 3 months, right? And then maybe it will get into another long-term consolidation like this one. But as for now, what do you do when you have a breakout and you are in price discovery? Or you just let it run. It's just, to me, it's just pointless to try to catch tops in a move like this. Just wait for the top to be put in, right? And it's just pure speculation on my end, but I would say next major pullback probably 3,700, 3,800, and then we'll see from there, right? It's just hard for me to assess gold right now because it's just going up. So I don't have any reference point. We'll see about that in the future, right? Let's have a look at Bitcoin instead. Now, Bitcoin had that bounce, right? It was, what was it? It was in here last Saturday. So we bounced actually. Currently, we still found resistance at the same level, which was rejection last week, or maybe even earlier than that. What was that? August the 28th. So maybe 2 weeks ago, right? Still, from a structural standpoint, we we were unable to break this high. Therefore, you should remain bearish up until you're told otherwise. And so since we have lower highs and lower lows for now, up until the point you can at least break a high or working on a higher low, I guess, yeah, we're not out of the woods. And as I said last week, I'm still thinking if this trend keeps on going, these bays won't hold anymore, because if you look at that now, a lot of liquidity which was contained in here has been dealt off at this point, so it should be empty. And even the bounce at 107, could you? I mean, one, two, three front runs of the level. It's kind of like the same logic that we were applying in here as for the 109,000 type of level. I mean, maybe a tiny bounce, but I think, a lot of what was here potentially able to sustain price has been dealt off already. So if this one comes down, I think it's not going to stop at 107,000. I think at the very least 105, 104 at this point. Yeah. Again, up until the point you can't actually break this structure right here, and therefore, trying to make a higher high right here, and then probably pulling back, working on a higher low, and then maybe try to go high again. But as for the current moment in time, the most likely scenario is that we've seen coming down, up, rejected, down, another bounce, and maybe now we got this type of movement right here, right? And we just go here below these lows in this pocket of liquidity right here. Could it go lower? Yeah, I mean, yeah, it can always go lower, higher, whatever. It's just, I'm just trying to assess probabilities as for direction, and identifying potential areas for another bounce. Nothing more than that. So at the current moment in time, I would say there's really nothing else to say about Bitcoin. It's acting like a risk-on asset, right? So treat it as such, I'd say. Now, we are going to skip yields and bonds for now, and we're going to look at stocks and equities, because I want to keep the yields and the bonds for the last segment, right? So a little bit of a change, a variation on the theme there, all right? So let's have a look at these stocks. Let's have a look at the heat map for the week. What we see, well, a bit of red, of course, because I mean, overall, the market, we're going to look at the chart in a minute, but the market didn't really go anywhere. But, if you look at some big names like Microsoft and Nvidia, they were down quite substantially. Although, I mean, 6% for Nvidia, is it really substantial, right? If you account for the volatility of the stock, I don't think it is. This is a stock which is able to be up or down 6, 7, 8% in a day. So maybe it's not that bad of a situation, right? Especially considering how high it was, right? So, I mean, I'm still thinking the scenario is the same. We are looking at some sort of a rotation. What kept the market kind of, let's call it alive, or it prevented the market from further downside risk was Google. There was a court decisions about Google. The case was potentially Google being forced to branch out and to let go on what was that? Was it Google Chrome? Maybe, yeah. I guess it was Chrome, because of some, arguments of free market stuff and competition issues and all the rest. How do they call that? A position, a predominant position, which is preventing free market. I mean, I don't remember the correct term, but that was the core of the issue. And it looks like at the end of the day, the court just said, well, no, nothing, Burger. don't actually have to let Chrome go, and you don't need to branch out and all the rest. So, of course, the market took it positively, and I guess it kind of helped the market to stay relatively flat in the end. What do I mean by that? Well, let's just look at that. Now we're looking at futures, of course, but if you check the what was that? Of course, we are not picking up Monday in here because Monday was festivity, so we don't have that. But let's just say that was this one here. This one here for the Nasdaq, it was a Friday close. And as for ES futures, Friday close was in here basically. So as you can see, the Nasdaq it closed here compared to here. ES it just closed right here, and the previous close was here. It's a bit clearer, I guess, if you go on a weekly time frame. There you go. So as you can see, didn't really move a lot. I mean, it was volatile as a week, but at the end of the day, the market closed kind of where it was last week. Nasdaq maybe a bit better, but still not going anywhere. The others, so the Dow Jones and the Russell, kind of the same story. As you can see, the Dow Jones is just kept on staying in this range. The Russell still benefiting from this momentum to the upside. So this new love for small caps is still there. Again, I'm a bit skeptical about it. Especially again after we've been looking at the labor market data in the beginning, because again, long story short, without repeating the entire thing, it's a much bigger reflection of the conditions of the domestic US economy, and I don't think labor market deterioration is a good type of environment for US domestic companies, or at least those companies which are making the most of the revenues domestically, right? So I think at a point this momentum will be faded, and we will get back to the usual type of environment where the major indices like the S&P and the Nasdaq are leading, right? Now, same as last week, we have seen the S&P making new highs, and yet new all-time highs, right? And yet the Nasdaq didn't. Now, NQ futures, they actually took out a previous weekly high, that's for sure, but no all-time highs, right? So I would be confident in saying that still we got that divergence in between the two. Now, I don't know how much weight you would put on it, but on the dump we've seen on Tuesday, NQ futures took out a weekly low while ES futures didn't. So again, probably another sign that ES it's relatively stronger for now. At least another confirmation, as if you needed another one beyond just looking at the trend. Um, it was kind of a strange week. Like, of course, Monday for festivity, Labor Day, so Monday was kind of sideways and not going anywhere. Huge dump on Tuesday, and then the recovery getting into Wednesday. Thursday really pushed higher and higher, especially late in the session, right? And overnight, as we can see here. And then we got the reversal on Friday when NFP came out. Now, look, is it, to me, it's always suspicious, right? When you see the market rallying like this, getting into a huge announcement or data point coming in. So I was already skeptical to begin with. And then, I guess when you start to look at the anatomy of this move up, all this liquidity is particularly thin. Like this segment right here was put in the Asian session, right? This one, it was very inefficient. So, I guess it was just a matter of let's look at how the data will come out. If they're bad, now the market has a reason, a catalyst to potentially pulling back. And structurally, there is a weak segment of price action which could be rebalanced. So yeah, I guess the pullback was very easily, or at least it was very easy to anticipate. It was a bit choppy around the open, so I guess it wasn't the easiest trade ever to get in. But nonetheless, because Friday was a day where, at the very least, you should have played it on the defensive side instead of, trying to catch every single dip intraday. Because again, I like to say, I like this phrasing a lot. Like when the table is set, right? It doesn't necessarily mean that something bad or huge is going to happen, but when you think the table is set for something, then you start to pay attention, and maybe you start to reduce your risk, or maybe you're a bit more selective with your trades and all the rest. And to me, the table was set. Uh, it was set in the stock market as, to me, it was in the bond market, but we are going to look at the bond market in a minute. So all in all, anyway, if you check the ETFs, did something drastically changed? I think not. I think it didn't. We're still in the same situation, in my view, where the market it's vulnerable, as you can see. Volatility, it's still kind of the surprise that you could get from one day to the next if you're trading intra-week. So just pay attention for it. But beside that, and the usual suspects, right, the divergences which is still present on the RSI, so momentum kind of weakening. We are still on a sell signal on the MACD again, so momentum being weak. As I said, I guess it was 3-4 weeks ago. Although you got a sell signal on the MACD, considering all the overall situation, it might just result in limited upside. So not yet a potential huge correction. Would I think we are still on the go for a potential, much more pronounced correction in September, which again, as we have been looking at it in the past, it's one of the most weak, if not the weakest month of the year as for the returns of the S&P, right? I think, again, it's another one of those things. The table is still set, in my view, so the risk, it's still to the downside, or at least, the risk reward of being particularly and massively exposed to the stock market, it's still relevant, in my view, and it shouldn't be discounted. But again, I'm a man of charts, so up until the point, again, we are living above the major moving averages, we don't have a structural break, you just can't really call for a 6, 7, 8% correction or whatever. I think the possibility is there, and if there is one moment throughout the year or in these recent months where I would expect something like that to arise, this would be the time, right? But price action always first. At the very end of the day, the ultimate harbinger is price and price alone. Right? So all the rest, it's just there to help you out, managing your risk, managing your expectations, and fine-tuning your decisions accordingly. All right. I guess when you check, this is the reason, right? This is the reason I think, because I'm so attached to try to assess risk. So it's hard to recover from drawdowns when they get particularly big, right? So look at the relationship. I mean, if you're down like 10%, right? In order to get back to even, what would you need? 11%, right? If you start to be down 30%, you need more than 40% of upside to get back to break even. And if you're down 40%, then you need a 63, 64% return in order to get to break even. So the name of the game, it's not losing money. or at least, I know it's impossible not losing money, and everyone which is telling you they don't lose money, they're lying to you straight out. But keep your losses very tiny, right? That's the name of the game. Take care and manage the downside risk, because if you do that, the upside will take care of itself, right? So you're a risk manager at the end of the day. Whether you are day trading on a 1 minute chart or you're investing for the next 6 months, 10 months, 1 year, 2 years, risk is always the primary thing you should assess. Your primary focus should be how much could I lose on this trade instead of how much could I gain. The gains will come, right, if you manage your risk, or at least the likelihood of the profits and the gains coming in will be vastly increased if you know how to manage your risk. So that's why I'm so focused on trying to find the cracks and all the potential risks in the market, because same as from a long-term type of a standpoint, and it goes even for your day trading activity. If you're doing it, you don't need to make money every day, and you don't need to score a home run every day. What you need is trying to make sure that those days where you lose, you're not losing your farm, so that those other days where you win are gonna actually be meaningful for your equity curve, right? It doesn't really matter if you are performing well for maybe 1, 2, 3 weeks, and then all of a sudden, in just 2 days on a random month, you basically take out all your gains of the past 2, 3 months, which is why, again, risk management is important. And it gets even more important if you add on top of it the compounding factor. When you get into a drawdown, you're losing that compounding. It doesn't really matter when people tells you, yeah, well, it's not about timing the market, right? It's about timing the market, because the more you stay in the market, the more you're gonna benefit from the upside and all the rest. Well, look, I know it sounds logical, but in real terms, when you look at the hit on your future return a potential drawdown could have, and how long it could take you to get back to break even instead of actually making money, timing the market at that point, if you start to look at things objectively and realistically, timing the market, although you can't be perfect at it and nobody really can, but at least a component of a timing, it's crucial. Again, whether you're trying to invest for the long term or making money in the short term. So just, I think at the end of the day, it could be just one of those myths that we can debunk. All right. Now, getting back to the stock market, just real quick. As for the positioning, it's not particularly worrying at this current moment in time. So we got, look like we are at 66% as of the percentile when it comes down to exposure to equity markets. So not particularly bad. What could be a bit more worrying, maybe, it's this one right here. This is just the highlight in between the discretionary versus the systematic strategies. So again, the CTAs, the algorithms, and all the rest, those which more often than not, I would say 95, 96% of the time, those which are really moving markets around. All right. They are in the 90%. So, maybe not really nose bleeding levels, but yet again, it's still in that range where if things start to reverse and they stop buying and they need to offset all, these exposure that they have, uh, they could do it really quickly and generate huge and volatile moves intraday to the downside. So again, just another assessment of risk. Doesn't mean the stock market will plunge next week, but something to keep in the back of your mind, right? So this would be it for stocks. I'm gonna end up with treasuries and the yields, and then we will wrap things out. So let's have a look at these yields, right? Uh, I don't know about you, but it looks to me like they just plunged this week. Now, these lines that you see, these diagonals, those are just my way, I'm sure at this point you should know, my way to assess relative strength and potential, again, divergence, same as we did for the stock market, like the Nasdaq and the S&P. Um, it's curious because every time you see this breaking correlation, some sort of a big move it's brewing, right? So for instance, you have seen one in here with the long end actually making a lower low while the short end was making a higher high. And from that, what it came, this drop, and this drop. And now we have seen another one recently with the long end making a high, right? Getting to 5%, whether you believe it or not. But, by the same token, the medium end wasn't making a high, it was making a lower high. And the short end failed to make a high. So still some sort of a lower high or an equal high. And what came out of it? Well, you just seen it this week. So sometimes those are very good telltale signs that something is about to happen. And if you check the trend, the trend is I just started like a lot. The trend is your friend, right? So yields came down like a lot this week. Now again, was it just on Friday because of what we've seen in NFP? Well, actually, they started to come down on Wednesday. So probably the bond market was already sniffing something out when we got like the JOLTS, the ADP, and all the rest. Or, quite honestly, it's not for me. It's not hard to think that they got privileged and insider informations. But of course, I mean, who doesn't, right? I mean, beside me and you and all the plebs, but at a higher level, I guess the majority of these guys are trading with insider information one way or the other, right? Still, there is also the other possibility. They have insider information because they are the ones moving the markets, so they do already know when they do want to buy or sell, right? But you know, I was already starting to think about it early in the day before NFP. So, there was already some telltale signs that we could have potentially we could have seen the move to the downside being exacerbated. And conversely, of course, Treasury futures, they just kept on going up and up. Um, Now, I I wouldn't say that this is a major change in behavior, right? Like, I mean, we have seen rallies in bonds over the last few months, if not years. And up until this point, let's go on a weekly time frame. As you can see, they have all been faded, right? So doesn't necessarily mean that this one is going to be faded or it's going to be a massive explosion to the upside. But again, I would think all in all, the odds for a sustained rally, I'm talking a macro rally. So I'm not saying it's going to rally from here to eternity. And every single day that you're going to see for the next 6 months is going to be an up day in bonds. I'm just saying if the premise of lower rates into the future still sticks, and again, I might be crazy, but this labor market data to me just kept on confirming what my thesis was. I think that there is the chance for a potential rally in this type of asset class, especially because again they have been the most hated. Nobody wants bonds, right? The world is rejecting U.S. Treasuries, and therefore they're gonna ask a much higher rate because we are fiscally irresponsible. The dollar is doomed. The BRICS, China taking over. Yeah, all the different narratives. But I still think that in the medium term, so let's say it's not a matter, I'm not talking about the next decade. I'm just saying, to me, it wouldn't be surprising, as I said in the past, to see rates getting particularly lower compared to where they are right now. I'd say in the coming months, so maybe 6 months, 9 months, something like it, right? But still, on a weekly base, on a daily base, they can still ebbs and flows like a lot. But I think fundamentally that there is no reason for higher rates. I'm sorry, Jim Bianco, but I don't see it. But look, if then we want to discuss, okay, do we get back to, I don't know, zero interest rates policy? That I wouldn't stick my neck out for that unless we have a financial crisis or a liquidity event or a financial Armageddon. But as I said in the past, I'm not calling for interest rates getting back to zero, but you know, probably 3.5% on the 10-year. As I said, would it be a very bold call, right? And I think, even if you don't believe the bond market will get back to the secular bull market, still a move like that in rates, it's, there are money to be made there. All right. So just, again, keep on keeping an eye out for it. Right. That's what I would say. Now, also because, is it is just tied to many different things. Like, for instance, if you see lower rates, right? What does it tell you about the debt and the debt burden, right? The interest payments on on the side of the U.S. government. For instance, let's just have a look at this for a while. So this is basically what would be the impact on the ability, or at least the burden of the U.S. servicing its debt if rates would come down by just 1%. I mean, we are talking a substantial amount of money, right? Because what it would be, the blue dotted trend line would be what? Maybe 700? And at the current moment, we are looking at what? 1,000 plus, right? So, when the debt it's so wide, a move in interest rates, although it looks tiny for you, just 1%, but it can impact like a lot. I don't think at the end of the day, the debt, as I said again many times up until the point I'm blue in the face, I don't think the debt is necessarily the problem. Sure, it's not good, but for many other reasons, not necessarily what many people think, as in, not being able to fund the government and all the rest, right? So just quickly looking before we wrap up the video, just look at this for instance. Like, if you think that whenever the government is issuing more debt, so issuing more treasuries, it's injecting more money, yeah, okay, nominally that is true, but what happens, right, to velocity? I mean, at the end of the day, if those money are not chasing goods and services, how can you have inflation? And it looks like, now I probably don't have it right here, but maybe I have it later on. But if you imagine a chart of the US debt, let's just pretend you are on the Fred database and you're looking at the debt of the US, you would see a chart going up and up and up and up, right? But by the same token, velocity over the last 50 years, it came down. So velocity came down, gross domestic product came down, rates, wages, and inflation overall, if you look at a regression line, it came down. So is the debt a problem in the sense that it's going to generate hyperinflation, rates going to infinity and beyond, and all the narratives that you're hearing in the mainstream media? Historical data would suggest otherwise, right? So I don't know if that's something you should take for granted. Oh yeah, this is some sort of a representation. So look at, this is the household debt, right, in gray, and you have M2, so the amount of currency units in circulation as measured by the US government. And I would agree, it's much higher than this if you would account for all the US dollars created and circulating in the much bigger euro-dollar circuit or system, right? Which are just escaping the measurement of the Fed in this case. But no deny, it's going up, right? Yeah, it's going up. What's happening to wages and salaries? Again, going down. What's happening to GDP historically? Going down. So growth is slowing down. You got more debt and growth is slowing down. Why? Because the debt is a drag on future growth. Because the more you issue debt, the more future money available, instead of being directed to productive investments, improving stuff, making stuff more efficient, innovating. A lot more of the future available wealth will be diverted into servicing the debt. So there is a negative multiplier. But again, if that is increasing, GDP is slowing down, economic growth is slowing down, therefore economic activity is slowing down, how can you have inflation? If inflation is just a representation, right, of economic activity. You can't have inflation if you don't have economic activity. But you might say, well, actually, you can have inflation if you just keep on expanding the supply of money. Yeah, but again, if those money are not circulating, it's hard. They're going to generate inflation. Otherwise, you would have to tell me why, after all the QEs for almost a decade, the Fed wasn't able to reach and stay at the inflation target of 2%. It was always below, right? So this is the real problem. When it's not about the US going bankrupt, the US not being able to service the debt, and the global markets rejecting US debt. The real problem for real people is this one. Now, when you see, like in here, just I don't know if anyone is familiar with the acronyms. For some reason, you do like these acronyms in the US, but DPI, it's the should be the personal income, disposable personal income, right? COL, it's the cost of living. So what you see in this chart is that up until a point, right, the cost of living was sustained by what? By savings, right? And by the wealth which was generated. All right. There was a point where savings keep starting to go down, right? And in order to fill this gap, since you were not generating enough economic growth, right, enough disposable income and all the rest, but the cost of living was still going up, in order to fill the gap, what you needed to do is keep on relying more and more on the debt. So this is the real problem when you're talking about the debt. It's not about the US going bankrupt. It's about the US citizens, real people, normal people, the people which actually count to a nation prosperity. It's about them being fucked over and over and over again, right? So standard of living going down, demographic going down, right? Society being dismantled. This is the real problem with the debt. And this is why overall, not only in America, but in the Western civilization, we should ask for less debt, less government intervention in the real economy. We don't, again, I'm going to end up the video as I started it, being a bit political. In my personal life, I don't pledge to the left or to the right. I would pledge for whoever would come in and saying, you know what, my main goal for the administration I'm going to build up is to step out of the private economy as much as I can, and trying to make so we, as much as we can, we try to get back to a real free market capitalism, right? But unfortunately for me, I don't think this is going to happen in my lifetime. So yeah, a lot of wet dreams. And which is why at the end of the day, I keep on picking and mocking on this politician or the other, on these bureaucrats or the other, just because I do think no matter where you stand, they are all the fucking same. First rule of the game, being elected. Second rule of the game, being re-elected. They're not working for you, and no matter who's in charge, if you are one of the average Joes and Janes, they're gonna fuck you over. No matter all the claims, all the marketing, all the propaganda, it doesn't matter. So I'm sorry for you. And again, this is why we, or at least me and maybe you, which are following me, this is why we spend so much time looking at these garbage charts and all this data. Just for what? Think about that. In order to make more money. Because gone are the times where you go to school, you get an education, and then you're sure you will find a good job which will pay you very good and will allow you to be the single person in the family which is working and can provide for all the rest of the family, having a nice house, 3, 4 kids, going to vacation and all the rest, and on top of it, being able to stock up and save something for your retirement and live in a good, latest part of your life. That's the end of the game. It's not about getting billionaires. At a point, it's just becoming something about being able to stay afloat for many different people. So yeah, okay. Again, sorry if I've been a bit, a little bit of a rant at the end, right? But I'm sorry, but this is what I think. You are free to differ. You're free to disagree. It's not really up to me to tell you what you should think. But yeah. That would be it. So after this tiny, maybe a little bit grim depiction of what the world is becoming in my eyes, I think we're going to call the day here. I'm wishing you a very good rest of your week and have a very good Sunday and be sharp for next week. Should we really look at what's going to come next week? Just for the US. Oh, another non-farm payrolls annual revision. All right. And then what? I thought, PPI. Yeah, I mean, it's probably going to be inflation week. If we got PPI, we should have CPI after that. There you go, inflation. All right. I mean, CPI, right? And on Friday, what? Nothing. Oh, well, Michigan consumer sentiment, but the start of the next week will be inflation data points, right? So be sharp for that. Another reason for volatility to step into the market, right? And with that, be nice and be cool. We're going to talk again next week. Nils out.
Mm-hmm. Mm-hmm. Mm-hmm.